what does move markets this week? We got an array, right? We got data, we have what's going on with Russia, we have China data, we have positioning. Mona Mahajan is senior investment strategist at Edward Jones. Mona, what's your call?
Yeah, look, I think I'm looking at a couple things this week. First and foremost, the inflation data that we get at the end of the week on Friday, core PCE, which historically has been the Fed's preferred inflation metric. We get a nice read for the month of May once again. If it does hold in line with the trends we saw in both CPI and PPI, we'll hopefully get a bit of a surprise to the downside in inflation. The other one I'm watching closely, housing data. We get Case-Shiller home price index data this week as well. I think it's Tuesday. Keep in mind, housing and shelter and rent broadly have been a little bit stickier parts of core inflation as well. So part of this inflation story is that over time, we think the real-time view of what's happening in housing, shelter, rent, all cooling in real time will over time show up in the inflation data as well. So I think this week's Case-Shiller price index should continue to move lower, which of course supports the case for better core inflation going forward.
Mona, do we not know enough about what is happening in Russia to factor it into our thinking? Theoretically, this could have a major impact on the global economy, but it's all theoretical. We don't know yet. And as a result of which, do I just park it, put it to one side, not worry about it and move on?
Yeah, I think you kind of summarized it well. Look, we've been dealing with the Ukraine crisis for over a year now, since February of 2022. It did have a pretty immediate economic implication through the commodity markets. We saw oil, energy prices spike higher. We also saw supply chain pressure indexes move higher, as well as global supply in that region contracted as well. Those were major implications immediately from the Ukraine crisis. But over time, we've seen those dissipate as economies around the globe worked around that crisis. We do think markets are in wait and see mode for what happens next. But for now, it is very difficult to handicap a geopolitical move. It becomes a tail risk more than a base case. And we do think over time, hopefully this crisis moves in the right direction. I think that is the hope of markets around the world, that we get a resolution rather than a more severe outcome.
But Mona, Lori Calvasino at RBC pointed this out, yes, and the geopolitical risk tension comes at an exact point where sentiment indicators are increasing to the upside. Retail investors also got in, and the summer seasonally is not great for equity. So just compound repositioning.
Yeah, look, I think we had a really nice run in the first half of the year. We're heading towards second half, believe it or not, but the S&P 500 is up about 14%. Yes, it's been driven by a very narrow set of leadership. It's a AI enthusiastic led trade here, but we are starting to see a little bit of broadening. Areas like industrials and materials, typical cyclical sectors, have started to show better performance as well. Small caps started to make a rebound as well. So we are starting to see a little bit more hope form in the market, but we do think, to your point, we're heading towards the second half where we have to have some questions answered here. And those questions are largely around what happens to the U.S. economy. Of course, many indicators are pointing to softening, including the ISMs, the yield curves, some of the Conference Board leading economic indicators, for example. But we do think some of that softening, as we talked about, has been priced in when we saw that 25% drawdown last year.
Yep.
So will markets kind of breeze through a period of cooling? Maybe not, but that could be an opportunity, we think, to position for better returns ahead.
Mona, okay, so what you're saying is you want to buy the dip when it comes. Is that, can I distill it down to that?
I think that is a summary of what we would think about. When we think about 2024, we see better earnings forecasts ahead. We think earnings will rebound. We'd see better inflation metrics ahead. And we see a Fed that has told us it's not only stepping to the side in 2024, it'll start cutting rates as well. So that backdrop seems more promising to us. So as we head towards the back half of the year, in any given year, 1 to 2 corrections are the norm. If we get any of those, we think start positioning for a broader market rally ahead, not just a narrowly led market, but also bonds, we think, start becoming much more interesting in that backdrop as well.
So I wonder, Guy, if the rotation that we saw last week a bit, or actually the week before, where you had cyclicals, you had industrials, you had small caps kind of doing better. Yeah. Yes, last week didn't really count, if we just look through it for a second. Is that become then trade more to the second half?
Maybe, but to Mona's point, maybe you get a big sell down in the middle of all of that, and that's the moment you want to be getting in. There's still tons of money, Alex, tons of money in money market accounts, and nobody can quite figure out yet where they want to deploy that money because they're getting paid to wait. How much longer do you want to wait?
Well, Mona, to that point, the money in money market funds, what market does that belong to?
Yeah, it's a great point. Look, we think that money in money market funds needs to start getting deployed over the next 6 to 12 months. And I think it goes to both markets. I think it can go certainly to longer duration bonds. You know, the short duration trade has worked really well thus far. But when you think about it, we're probably heading towards some sort of peak in Fed funds, which means a peak in Treasury yields as well. And that's a great time to extend duration. You not only lock in some of the better yields, but then over time you get price appreciation. If yields, over time, the Fed pivots lower as well. And then we talked about the equity trade. So we think, it's not a wholesale trade out of your money market funds, but start thinking about complementing, cost averaging in across the board. You don't want to be stuck trying to reinvest in an environment of lower rates as well.
How do you sequence that, Mona? How far away are we from the best rate you're going to be getting on the 10-year? How far away are we from the best rate you're going to be getting on the 2-year? Is that still to come, or do you think that is priced now?
Yeah, historically, and we've run some numbers on this, it's about 6 weeks ahead of when the Fed funds rate peaks is when Treasury yields tend to peak as well. So, we could be really talking about the weeks ahead where we start to get the peak in Treasury yields. Now, markets are, of course, notoriously difficult to time at the top or the bottom, but we certainly thinking about this trade in the weeks ahead makes a lot of sense. We think the Fed will go one more in July, probably leaning towards a pause after that, but of course, very data dependent. And so we're really talking about a yield environment that's looking to top out in the weeks and really months ahead. And so I think that is the opportunity. When we think about the duration trade, for many times we're neutral, but really when you want to get involved is when you see these inflection points. And we have one inflection point in the Fed moving to the sidelines, but the bigger inflection point is when the Fed pivots lower.